All right, everybody. I'd like to welcome you all to our final panel of the day, and the one I'm really excited to do because this is the first time ever it's been done at a MicroCap conference, which is quite niche. With that, I run this podcast called the Planet MicroCap Podcast, which is all about educating the next generation of investors how to invest in microcap stocks, and been publishing it since late July 2015. And everybody that you actually see on this panel today has been a guest on the podcast. And you probably are asking yourselves, why would I ever put Chris Lahiji on this panel? As well as, and
I know why.
And the reason being is that, I've been going to Chris's conferences for a long time, and, he's really contributed a lot to this space, been around and seen a lot. And, I always appreciate having his insights, and I think you definitely will too, as well as Mr. Brandon Mackie, who's the editor of Small Cap Discoveries, along with Paul Andriola, who spoke a little bit earlier today. He's, I'd say, one of the young up-and-comers in our space that is really following it and, bringing some awareness.
The guy's
to this
57 years old. Young up-and-comer. He's hitting a stride. The guy's an AARP member.
And next, we have Mr. Jason Hirschman, who is a private investor, goes by the Twitter handle and MicroCapClub handle of 8Track. I really enjoyed our conversation that we had, and I thought that he would be a great addition to this panel. And last but not least,
I'm also local, by the way.
And he's a local. That definitely helped. No, I'm just kidding. And last but not least, I'd like to introduce Mr. Chris Irons, better known as, quote, the Raven or the Raven. And Chris and I had a great conversation, and I'm very excited for you all to hear his insights as well. So with that, I didn't want to provide too much of an introduction because I wanted them to sell themselves first. So as we do with each of the podcasts, to start off, I'd like to get everybody's background and who you are and how you approach investing in microcap stocks. So, let's start with Chris, or the Raven. Start with you.
All right. Hi. So my name is Chris Irons. Currently, I actually work with Maj at Geo Investing. Oh. And awesome. We gonna make it or what? Oh, jeez. All right. So currently work with Maj at Geo Investing. My Twitter handle is @QTR Research. I started in 2012 writing under the pseudonym, quote, the Raven Research. Really, I've been only in the microcap space primarily, like with a focus on microcaps for probably the last 3 or 4 years since I've been working. What's that?
You're lucky.
Thank you. I'd be lucky if I can get through this opening statement. Thank you. Good night, everybody.
Opening statement.
That was good, Chris.
I don't know what the hell I was saying, but generally, I started investing when I was 18. I lost a lot of money. I learned how to trade equities, options, futures. Just basically lost money doing all of those things. Tons of money. Lost money trading FX for the first time. And so really, I didn't go to school for finance or anything like that. I'm actually a writer by trade. And that just kind of meshed together with what I was doing and learning the capital markets. And so I spent 8 or 10 years just losing money and being miserable, and then finally landed a job working investor relations for a small startup company. So, learned a lot of things from the inside out, working with the CFO, working with securities attorneys. And then eventually after that, I started writing and doing research on my own, mostly a lot of short activism, a lot of special situations, things like that I really prefer to do. But then when I went to Geo Investing in 2013, I think I started there, was really when I first started to hone somewhat of an expertise in microcaps. And so Maj covered a lot of that in his panel. But generally, if you had to sum up our microcap investing approach, it's information arbitrage. It's, microcaps are nice because they're a niche of the market that aren't covered by analysts. They're not covered by a lot of people, on the street. And so if you can do the work, you can do the down and dirty work and get your elbows dirty and read the filings and read the 13Ds and, all the tiny little print at the bottom of the page, you can generally find some interesting opportunities. And so if I had to sum up what we do, I would say it's looking for information arbitrage.
Jason?
Sure. My name is Jason Hirschman. I'm the classic combination of small businessman by day and investor by night. I've been investing since the mid-'90s, basically when I graduated from college. I post a lot on the MicroCapClub and also on the Motley Fool boards. Basically what I do is I've been involved in a family business since, since I've been growing up, kind of you, Bobby, and just take the experiences that I've had in my, running my own business in terms of whether it's product development or sales or marketing or being involved in patent lawsuits as a plaintiff or defendant. And the great thing is you can apply those experiences to in the microcap world very, very easily. So, I think we all know why we invest in microcaps. It's a fairly inefficient space. That's the benefit of it. You have to do the hard work. You got to talk to management. You got to look at the filings, and that's how you make money. So, that's why that's why it's an area that I really love to invest in. So I'll just leave it at that.
Brandon?
Hi everyone. My name's Brandon Mackie. During my day job, I work at a food technology startup in Los Angeles called Soylent. We make a tasteless sludge that people live on, if you've ever heard of it.
If anyone has ever seen The Matrix, you know that crap that came out of the machine, and the guy said, Neo said this doesn't taste like anything? That was Soylent.
It's kind of a crazy story for another day, but it's founded by my roommates from college, and they called me up a number of years ago to come on board and come help grow the company. So that takes up a lot of my time, but I've always had the investing passion, and I write a newsletter with Paul Andreola right over here called Small Cap Discoveries. How this all came about, I'm a chemical engineer by background. I was working in Houston, Texas, and got the value investing bug and was reading every night Benjamin Graham, Warren Buffett, and had an idea to start a blog, and that blog was called Motology. If anyone read that back in the day, the idea was basically to take Warren Buffett's Moat framework and apply it to microcaps, looking for very niche things. So I was investing in everything from regulatory software companies in London to Swedish brewing companies, all over the world. And through that, I got hooked up in the MicroCapClub, and then ultimately connected at LD Micro, which you put on by this gentleman right here. The first time I really met a lot of the people that I would go on to work with. There I was a lot of Canadian companies, and one of 5 people in the room watching the Canadian companies present, and the same 5 people seemed to be in every one of these presentations. One of them was Paul, and we got linked up writing the newsletter. Did a brief stint at a hedge fund that found my blog and invited me to work on. And then ultimately, my buddies from the startup called, and so I moved out to LA about 3 years ago, and have been there ever since.
Brandon, you invested in a Swedish furniture company. Was that company IKEA?
It was. Got in at 10 cents.
Oh, they're very nice. Very nice.
Brewing.
Yeah, it was actually one of the best biographies I ever read, Ingvar Kamprad. And what was fascinating about IKEA, he basically started selling pens, and it morphed into a massive multinational furniture powerhouse. What makes IKEA so unique isn't the fact that they sell cheap furniture, it's the fact that they can ship furniture more efficiently than anybody else in the world. So furniture making is cheap, it's just shipping it that was expensive. That's what IKEA figured out. Well, my name is Chris Lahiji. Sorry, that was like the the more you know, like that NBC thing. So, my name is Chris. I've been very fortunate in my life because from a very early age, I knew exactly what I wanted to do. So I got the bug when I was 12, 13 years old, and my dad, being the first and only client I had, basically trusted me with his life savings, which was roughly $250,000. And I always say that there's 2 types of Persians, okay? So I am Iranian. There are the types that were descendants of the Shah, or they kissed the Shah's ass, and they came to this country with a lot of money. And then there were the Persians who didn't kiss the Shah's ass and unfortunately had to work for everything. We were the latter. So he gave me all his money, and he said, look, just please, for the love of God, don't lose it. And I lost about 90% of it in the first year. I was big in a company called Fila Holdings, and Fila was very popular in the early 90s. They had one sponsor, and that was Grant Hill. And Grant Hill got injured, and then no one wanted, you don't want to buy the shoes of someone who's always like injured or on the bench. So Fila did not do very well. And what happened as a result of losing all his money, I basically got in gear. I went to the library on a daily basis. I learned all the things from Graham, from Dodd, from the greats, Peter Lynch. And I slowly but surely inched my way back up to $250,000 and much, 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 much more than that. But my take is that my goal has always been to own 1% of a 10 million market cap that becomes $1 billion company. And I still haven't been able to do it. We've been close, but it's just that pursuit, that feeling that you know that the next card you're going to turn is going to be the ace of spades. And for me, it's given my personality, I tend to be a little bit more volatile than most people, just like the stock market. So it's pretty cool that things can change on a dime at any given time. So you always have to be on guard, and I'm just really fortunate to be amongst my peers here, and hopefully we can shed some insight to everyone today.
I was going to say, coming right back to you, because one thing Chris didn't mention is that he runs a website called ldmicro.com, where it has its own index, and he really on a day-to-day basis is really seeing what's going on in the microcap space. So my next question right back to you is, what are some of your observations thus far in the microcap space for 2017?
So to very briefly go, our job, the way I look at it is we want to be the John Stockton of the microcap world. We don't care about how many points we put up. We don't care about how many rebounds or steals. We care about assists. So what was happening is that over time we were becoming a larger and larger force in the space, and I was looking at all the things that the industry did not have, and one of the big things that we never had was data. And I couldn't understand how there's 100 different sites for small cap and mid cap and large cap, but no one gave a shit about companies, sub 250 million. So we went to a lot of our sponsors and we said, well, is this on the basis of cost? Or is it just something that is not technically capable for the smallest names? It turns out that it was a money issue. No one could make money selling data in the microcap world. So I said, well, what if we don't want to charge anything? What if we give it for free? So a lot of people look at the events and they say, wow, look at this, Chris, he has 80 sponsors and 500 companies that pay him. The first 4 years, the events didn't make any money. The website doesn't make any money. But now there are a lot of people, hundreds of people, and some days over 1,000, that come to the site and very quickly, within a 2 to 5 minute time frame, can see exactly what the smallest names are doing with the index, all the big movers and shakers out of the 11,000 microcaps in North America, get a live news feed, and then be able to screen search the world. So these are all the things that I always wanted access to, but I never had. The logic was, if we were going to build it for ourselves and spend $300,000, $400,000, $500,000, $600,000, why don't you just make it in a way where everyone has access to that information? So the events were the same thing. I used to go to sell-side conferences all the time, and I would see the same companies over and over and over and over again. So I said, why can't there be a conference that's based off the quality of companies? So as Ron and a few of the people in this room went to the first one, they looked at companies for the first time based off valuation, based off EV to EBITDA multiples, based off book value. And so our take is that data for us in the microcap world will be significantly greater than anything we've ever done on the event side over time.
So what are you seeing though? What's been going on in the last month?
Oh
or
man,
two?
shit's been crazy. It's really amazing. One of our largest holdings is a company called Auxilio, AUXO, on the NYSE. And we've owned this thing for a long time. And for the most part, there were entire quarters, you guys, where there was virtually no trading. No one cared. They've probably traded more in one quarter this year than they have in 5 years. So it all depends. The way that I look at the microcap world is, and I tell this to executives all the time, imagine bashing a piñata, okay? It's going to be elusive at first. You're going to swing as hard as you can, and you're probably not going to dent it. And you keep beating the shit out of this piñata, and it still has its structure, it still has its vibrant colors, and it irritates you to death. But one of these days, you're going to hit that piñata, and there's going to be a dent. And then there's going to be an incision. And then that's when you really start hitting it, and then obviously, hopefully all the candy comes out. It's the same with being a microcap, in the sense that Auxilio put out incredible press releases over a 5 to 7 year span, and no one gave a rat's ass. And now they go to a conference and the stock is up 20%. So it's one of these things where, it only takes you 15 years to become an overnight success. Mm-hmm. So if your company gets selected for that and you have real liquidity, that's when the valuation really starts to showcase itself. And then there are probably a lot of companies here that still don't trade any shares. Another example is a company called Dynatronics, DYNT, based out of Salt Lake City, Utah. They do light therapy. This is a phenomenal company. Their largest competitor got bought out for 1.5 times sales. They're trading at 0.2 times sales. There's some things that are taking place on the On the management side, that's pretty significant. No one cares. He trades 1,000 shares a day, okay? And those 1,000 shares are probably me. So it's one of these things where the way that I kind of see the universe is you buy a little bit and you don't need to sell and you stay patient, and then hopefully, God willing, one of these days there's a lot of traction. So, but what we're noticing this year is that a lot of these companies are getting traction for the first time in a long time, and it's just really nice to see, inflows improving, and they have. Year over year, inflows are up a lot based off LD Micro data. And the other thing is pipes, from my understanding, are up 70% year over year. Most pipes are taking place in MicroCap. So you have deal flow again, and you could see it in some of these names, the way that they trade. But it's been basically purgatory for a long time in the MicroCap world. I mean, from 10 on, some people may have had good years and some people may have had bad. But there was really not much happening until the last 6 to 9 months.
Mm-hmm. So, Brandon, you cover the Canadian space mostly. So what are you seeing trend-wise going on in Canada amongst these Canadian microcaps? What's going on in 2017?
Yeah, sure. So, when I think about that, I think about myself, and I'm a U.S.-based investor that invests 100% in Canada. And people ask all the time, like, how is that possible? Why? That's so bizarre.
We got to call Trump.
Don't tell Trump. Yeah. But I look back, and when I started out, I was purely looking at valuations and quality of companies. I had a criteria. I didn't care where they came from, as long as I didn't even care that I could read the financials. The Swedish company only posted in Swedish, and I used Google Translate to read the financials and invest in it. So it was purely fundamental based, and I think a lot of investors in the U.S. have got to that point where what maybe always worked in the U.S. wasn't working, coming out of the crisis and. In 2009, and so they started to look at some of the Canadian companies and a lot of the success stories that were coming out of there, these stocks that have gone from 10 cents to $3. BioSign, which I don't own, is one of the big success stories that got people really interested in the space.
RX.V.
RX.V.
For full disclosure,
yes.
are you shareholder? Just for full disclosure, are you currently a shareholder?
I am not,
Okay.
and have never been. But that was one of the ones I was like, oh man, I missed that. I need to pay more attention to this space. And I think a lot of investors in the U.S. And honestly, we see through our newsletter, there's people in Korea and all over the world, Europe, Luxembourg, like they're getting really interested in the space because they see the return potential. Where there's few things out there that'll give you any kind of return. And so, while it's great to be long in a position where people are coming in, the reality is the valuations of a lot of these companies have gone up. And I always think about it when I find a very early company that meets our criteria, the growth's there, 25% revenue growth, it's 2 profitable quarters. A lot of times you are finding those at 5-6 times earnings. It would be a very standard number to say like, wow, this is undervalued, it's a no-brainer. Now when we're first finding these, they're at 15 times earnings right off the bat. And so now maybe you say that the growth is there and it's gonna continue to expand, but you can see that that's a 3x shift right there. And it's a kind of a heuristic that I've been looking at, but there's very few things under 10 times earnings that are just staring at you straight at the face that make us want to go in and invest, all in.
So Jason, what's your take on what's going on in 2017 so far?
I mean, I'm probably like a lot of people in this room in that, we all tell our friends who aren't invested in microcaps that there's about a gazillion companies to look at, but then they ask you, well, how many are you invested in? You say like 4. And so basically, I mean, it just comes down to the criteria. If I can find something at a price I like, I buy it. But what kind of scares me a little bit is that, I mean, and for the past year or so, I've been talking to more Canadians than Americans when it basically comes to investing. But it does seem like, the Canadian market now, there's a lot of eyes on it, and maybe it's time to come back to America.
Well, no, we can't find anything we can't find anything here. So we have to look in Canada. You're doing the exact inverse.
Yeah, but what I'm saying is that it just seems like, like Brandon just said, the values aren't what they were, let's say a couple of years ago, but you have a lot more eyes looking for it, and people are sort of trying to copy your formula or the other formula, which is okay. Look for high revenue growth. Look for companies that profitability, and then they're just trying to game each other. So, well, instead of waiting 2 quarters, maybe I can get in on 1 quarter, right? And that it can work, but it's also a little more dangerous. You take a lot more risk. And so, I think there's individual values out there, but it's not as easy as it was. And sometimes it's the best thing to be is a little bit more cautious. And that's the way I feel about the market right now.
Just to follow up on that real quick, why do you not see it be as easy as it was? Is because there's a lot more eyeballs now on the space?
I think it got very, very cheap at basically early 2015. I mean, there were a lot of people who were microcap investors, and they were just depressed. You had to you basically had to quote Ibbotson, data to your friends in order to justify being a microcap investor. And now things have changed some, right? You can actually point to good performance in your own portfolio. You can look at other stocks that have, that really had great runs, and you can say, there's a good reason to be a microcap investor. But, success is the seed of failure in some ways. And, people start looking at other people's success, and instead of playing to their own game, they start playing to other people's games. And that's how you lose money. So, my feeling is look, I do very well. I'm sure everyone here does very well. You don't have to become a billionaire overnight. So, be patient and wait for something in your swing area, swing zone, and then swing. So, if I find one or two companies a year, I'm a concentrated investor. That's fine for me. So.
All right, so Chris, what's your take? What do you see what's going on here?
Well, I would, first off, I'll just say, as a short seller and somebody that works primarily in special situations a lot, my favorite type of investing is to find some type of enormous volatility in an equity or a company, whether it's, somebody has come out with a short report or, there's been, they're conducting an internal review of the financials or something like that, and then trying to actually deduce what the facts are quicker and faster than anybody else. So I used to, and unfortunately still do, go to microcap conferences also to look for great shorts, because what they're saying is there's nothing to find, because where you would go and look for a company that it has 2 quarters of profitability and has a fantastic balance sheet and has finally already turned the corner, that those companies are drying up or they're becoming investable or discoverable now at higher multiples. Yeah, what I would what I would say almost, as a challenger, as a respectful disagreement or whatever, is if you look to try and find companies, and this is what we try and do a lot of, certainly we like companies that are simple, free cash flow generative companies that are already profitable and have fantastic balance sheets, and certainly investing like that is a fantastic way to invest, and I'm sure it's led to a lot of successes. What I would also say is there's something to be said for going and taking a look at a company that may not have the best balance sheet, may not have 2, profitable quarters behind it, may not, be cash flow generative, but perhaps has a narrowing loss, or, like Maj was saying earlier, a company with some type of special situation in place. One company we dealt with had, an overhang, a liability, a pension fund liability, and nobody wanted to, we don't know if nobody knew about it or nobody just wanted to bother with it, but it just seemed like everybody just stay away because they've got this overhang, and then when that clears up, the stock will be okay to invest in, and it's like, yeah, that's great, because everybody else that doesn't want to do the work and doesn't want to look at it, they're all going to discover it once the pension liability overhang is taken care of. Everybody knows that, right? And so what we try to do occasionally also is seek out situations where a company is maybe 4 quarters or 3 quarters behind where he's trying to discover companies. We're looking for the inflection point that's going to allow us to access an investment in a company, perhaps before they're even profitable, perhaps when they have a special situation, an overhang or something like that, that's going to eventually be resolved one way or another. So while certainly it's a riskier way to invest, it's definitely, see, the thing about investing early with microcap companies, we like microcaps because they're small, right? Smaller companies, they trade like options. They have enormous runways in front of them, so you can make ridiculous returns. You can make 100%, you can make 1,000%, you can make 10,000%. I mean, Maj was buying Monster Beverage at something like $2 a share. I don't know what it was, but way
when it
way
was
back.
called Hanson's Natural, huh, Maj? Yeah, right. What was the market cap? I know, because I was in there. And then I sold it at like 9 and laughed at people who bought it at 9.5, and it's now like $2,000 a share. Yeah, it's kind of stupid. Sorry, Raven.
That's okay. So, anyways, Maj invested in Monster back when it was like $2 or $3 a share or whatever. and like I was saying, the reason we like microcaps is because they have this enormous runway in front of them, right? If you invested in, a company like Monster, which is a billion-dollar company now, multi-billion-dollar company now, if you were in there at 1 million, you were in there at $10 million market cap, you were in there even at $100 million market cap, you've made an insane multiple of your money, right? It's been ridiculous. The crazy thing is, the math behind that is such that the investment returns can be exponentially higher the earlier you get in. So if you go buy a call option for a penny per share and it goes to $1 per share, you've made 100 times your money. But if you wait 2, 3, 4 quarters until the call option is a quarter, you make 4 times your money. And certainly, again, there's something to be said for that, because it's okay to be safe and it's okay to be conservative. But what we do is we pepper in a lot of trying to find companies before that inflection point. Because if you can get that, if you can get access to management, and you can find out information that the sell side either doesn't care about, they don't bother looking for, that's really where you have an opportunity to make ridiculous investments. So, we certainly do a lot of looking for cash generative companies with fantastic balance sheets. We've also, in maybe trimming through a bunch of our companies that were potential shorts, have inadvertently come up with a long thesis or two and discovered companies early on. So just to round out what I'm saying and actually address your question now, basically I agree with everything he said, which is, microcaps are at a point where they're. I was pointing to him, not you. Next time I'll be clear.
Thank you.
So, Jesus Christ, I lost my cue. But anyways,
I'm telling you, man, I'm his kryptonite tonight, dude. You can't every time. No.
The point of the matter is certainly what he's saying is correct. The space and people are kind of moving to the space now, and that's why these valuations are being pressed up. Where companies that I used to be able to find at 5 or 6 times earnings, are now at 10 or 15 times earnings. It's also a product of the overall market frothiness that we have, which is a kind term for complete insanity, which is what I call it. But certainly investing a little bit earlier on allows you to maybe access that inflection point. So
I was going to say that actually ties right into my next question, which we talked a little bit about on our pre-con meeting. And what I really want to know is, how do you guys see certain macro events affecting the microcap space? So, here, Chris, or Raven. I'm going to go by Raven
whatever
because
you
we
want.
got 2 Chris's on here. So I'm going to go Raven and Lahiji. So Raven, let's go back to you real quick on this, and then we'll make our way down the line.
Well, I just think, this dovetails from what I was just saying, right? Which is people are starting to discover microcaps. I mean, the cool thing is everybody here, we're all kind of in the know, right? That these companies fly under the radar. Right? Goldman Sachs isn't covering them. JP Morgan's not looking for their investment banking business, so they don't really give a shit what the company's doing. A large sell-side fund doesn't want to go out and close a $5 million financing because they have better things to do. And so the nice thing for people like us is we know that there's a relatively small select group of people that have access to this information and care enough about it to look at it. So that's why microcap investors have such an enormous advantage. To tie that into the macro picture, the nice thing that I would say is that microcaps aren't always a beta trade, meaning they don't always move with the market. That's obviously sucks when the market is doing what it's doing now, but that can actually sometimes work to our benefit. If you're from the same school of thought that I am, which is basically that the economy really actually hasn't had a recovery here in the last 8 years, and we're basically going to be heading for an enormous disaster, which I know doesn't sound great, but unfortunately that's how I feel.
Dow 50,000, baby.
Yeah, I think the Fed has done equity markets a horrible disservice. I think interest rates will never go up again because the United States will not be able to service its debt. I think we're going to see hyperinflation. I think, I like gold. I like precious metals. So I'm kind of like one of those doomsday conspiracy theorist guys. But the nice thing for microcap investors is what's that? Do you agree with me?
No, I don't.
Yeah.
But
Well,
go ahead.
I'm going to take that as you agree with me anyways.
Gold
At
is
least
at
until you rebut me.
$50, baby. Long live fiat currency. Woo!
Just to close out what I was saying, I think that microcap investors have an advantage because they're not always tied to the market. So if all hell breaks loose, it's not going to change the fact that a little $10 million company is cash generative and is doing well and, hopefully selling a product that is going to continue to be in demand. So
I respectfully disagree with Raven. And the reason is, remember what happened in 08 and 09? Everything It didn't matter what it was. It imploded. Volumes dried up. Everything was down 70, 80%. The worst part is, in MicroCap, you have a high degree of risk going to any of these companies because what you buy is probably what you can't sell. And then when everyone is just selling shit across the board, it's like shoot first and ask questions later. They were things that were basically completely discarded. Another thing is for you Canadian guys, wasn't it a couple years ago when your venture exchange was down like 80%? An entire exchange is down like 80%? Now, granted, they were all, BS,
Mining.
gold,
Mining.
mining.
Yeah.
I got 2 trillion ounces of gold down there. It's like, how much money did you make last year? We lost 85 million. It's like, oh, okay, cool. But look, the consensus is that we are almost like, we're at the tip of the sword. So we get, it seems like we get the benefit last and we get hit first.
Chris, would you agree that microcaps, are probably in terms of all the different sizes of companies from nanocaps to mega caps, whatever you call the big guys, that they're probably the least correlated to the overall market? Would you
I would agree with
that?
that, Raven. Yes.
Okay, I rest my case. Because that's all I was
Rest
trying to
what
say.
case?
That's all I was trying to say. I was just trying to say
Do you agree
that
that 2 times 2 is 4? I do.
the point I was trying to make that everybody here seems to understand, but you don't, was that they're the least correlated to the market. So they may not be the safest bet if everything crashes, because of course if everything crashes, there's going to be pressure across the board.
Raven is right.
But the point of the matter is, I find that they're the least correlated. If a market moves down 80%, Apple's moving down 80% with it. But if a market moves down 80% and you own a microcap that is thinly traded and a liquid, which are the points that he's bringing up, it's not necessarily going to make the same move.
You're right. It's going to be bankrupt. Oh!
The decline in the price of an
I
equity.
love how I have to make my
Can I
own
just say
sound
something
effects
real
because
quick?
nobody else
Oh,
did.
Chris.
The decline in the price of an equity would not cause a company to go bankrupt if they're cash flow positive or they're profitable.
You are correct.
I know.
Jason, care to comment?
Well, I just gonna. I don't even know where to start. I don't even know where to start. But let me just finish where you said, like, one of the advantages of being in microcaps is that you can access information. But I think in some ways the next frontier is actually almost to create information. I don't mean pumping, but I mean actually to create insight. And just want to give you an example, and I won't use the name, but there was a Canadian company that was sued at basically the end of 2015 in basically automotive paint protection film. And partly this is one of the advantages of coming to conferences like this. You meet people, and I basically made a friendship with a investor up north who I think you'll be interviewing soon, Meredith. And basically the way we actually created information and created insight is by taking the film and actually bringing it to laboratories, reverse engineering it, and then determining that it did not infringe, in this patent lawsuit. Okay, and that's a way to actually, I think, is the next step. Spend some money when you get opportunities like that, and you can, to go out and actually get insight way beyond just even talking to management. Mm-hmm. And so, obviously, opportunities don't come along like that too often. But I do think it creates another way really to profit, as in the microcap market. Because, if it was Apple, everyone's going to look at the validity of the patent. They're going to test things out. But in microcap, nobody does that work. So you actually got to team up with people who have other skills besides just investing. Mm-hmm. And basically together, you really often can bring something to the party. And basically for me, that allowed me for a 7-month stretch basically to be 40% of the buy volume in that stock. And we did very well with it, and hopefully do even more. But so I think that's really the next step of basically like you said, private placements, but also looking for opportunities really to bring in other points of view that really create value by creating new sources of information. So just a thought.
No, absolutely. So I wanted to get to my next question. This one I wanted to go to Brandon on, and we've kind of touched on it a little bit already, and I can almost forecast a little bit of what you might say to this question. But where do you currently see value in the microcap space? And let's preface, it's probably going to be Canada. I know that's what you're going to say, but maybe let's get a little deeper as to why Canada right now specifically, especially after it's kind of getting a little, I don't know, there's been a little bit more awareness for it.
Sure. I'll start. I just want to add a couple comments on the discussion in the last question.
Yeah, sure.
we had a great dialogue in the call before this, and it seems like we're on one team and they're on another team.
We did not.
And I've always felt that economic doomsaying is a fun hobby, but it's an expensive hobby. Meaning that if you look at the people that have been saying this, since I bought my first stock in August 2011 when the S&P went down 500, there's been people that have been saying the same narrative that inflation and monetary policy and the Fed were all doomed. And I imagine that those people have either lost a lot of money just outright on their trades, or B, more importantly, they've missed a lot of opportunity to go long. And that doesn't mean you can completely ignore the macro environment, but the way I like to think about incorporating macro in my framework is almost like you play the macro through the micro, meaning like you look at your individual stocks and if one of them is overvalued, then you're selling based on that. And that typically correlates to when the overall macro is frothy, but you're not doing it because you have some viewpoint on the macro. And that's kind of the framework that we've tried to employ. And I think that's what we've been doing in Canada. Some of these things that get institutionally owned and they run up too fast, we've been taking some off the table and moving to cash. And then you can look, 6 months, 12 months down the road and be like, well, I'm now significantly in cash, but it's not like I woke up one day and read some news story and got scared and went 30% into cash. It happened very systematically through evaluating each position. And so where do we see value then? So,
well, real quick before we get to that, I wanted to give Raven a chance to respond because I think it was kind of like
I'll be very brief. Thank you.
Fire away.
Yeah. So look, he's 100% right when basically what he says is, doomsday sayers and people that go on TV and say, the whole world is screwed have probably lost money here and there also. I mean, the market undeniably has gone up over time, right? So if you invested $1 in the market in the 1930,
yeah, exactly.
What's that?
It's worth a lot. I mean, it's huge.
Yeah, that's what I was going to say, actually. So if you invested $1 in the market in the 1920s, and just let me get through this here, all right? Just give me 2 minutes. If you invested $1 in the market in the 1920s, you made a ton of money, right? It's worth whatever. It's worth $1 million today or whatever, right? This is a question of ideology, right? Nobody's denying that the stock market continues to go up, which is why Warren Buffett gets on TV and he says, I would buy stocks that, I want to own for 30 years. And they say, well, Warren, what do you think about, 2008? All hell's breaking loose. People are losing their jobs and unemployment's, at record numbers. And what he says is, well, the stock market's going to be higher in 30 years than it is today. And so what I do is I just buy companies that I want to own for 20 and 30 years.
Like Kraft.
And by the way, I knew I wasn't going to get through it. But anyways, by the way, he's absolutely right? He's made a fortune by buying and holding, right? So there's definitely a case for that. But at the end of the day, it's a question of ideology, right? If you buy into Keynesian theory, right, which is essentially that the Federal Reserve needs to protect markets and needs to protect equity markets for benefit of investors, then you don't buy into free market capitalism for the most part, right? The Austrian School of Economics say that bubbles bursting and booms and busts should happen naturally, and with that is going to come some volatility. And that's a good thing, because that's the market correcting and readjusting itself and whatever. But the reason the stock market has gone up since the 1920s is because of earnings growth, but it's also because of inflation. And inflation is this thing that has been made up and is now managed by the central bank, which is 50 years ago, this guy says to me, I could get a cup of coffee for 5 cents, right? And today, a cup of coffee costs $4.95. And nobody really gives a shit about that, and nobody says anything about it, because everybody just expects it. Yeah, prices go up, so what does it mean, right? Prices go up because the Federal Reserve has printed an enormous amount of money. And inflation, under Keynesian theory, is supposed to be a good thing, right? Free market capitalism is supply and demand will drive the prices, right? You should have a relatively finite set amount of whatever your currency is going to be. And by the way, before you laugh at gold bugs and doomsday sayers or whatever, gold is up 400% over the last 15, 20 years. And it's also outperformed the S&P over the last 5 to 10 years. But whatever, I'm cherry picking my numbers a little bit, and I'll admit to that. But the point of the matter is, if you buy into Keynesian economic theory, which is that Janet Yellen needs to manage the equity markets because we can't handle a 1% correction, or we can't handle a 5% correction. All that does is lead us to huge problems. And we're going to have huge problems again because we have been issuing debt at 0% or close to 0% since 2008, right? Interest rates can't go any lower. So if you look at a historical quote of interest, a historical chart of interest rates used to be 5%. They were 10%. They were over 10% at one point. And what you see, since the Federal Reserve has taken control, is you see interest rates lower every time that we have some type of economic turmoil, which is the Fed saying, holy shit, we have to do something because everybody's panicking. And then you see them rise a little bit, but they make lower highs and lower lows every time they manage them. Well, now we're at zero, and we can't raise rates again. So we have the option of going to negative interest rates, or we have the option of QE4, which will probably be next. And all I'm arguing, and I'm not disagreeing with you that buy and hold investing is a great way to make money, because it certainly has. I'm just buying into the fact that at some point, something will have to give. And what will happen is you will be taxed because prices will go higher. If productivity stalls out and prices start to go higher, it's a tax on everybody that people don't understand. Because the average person goes to the store and buys a gallon of milk today, and it's $4 instead of $2, which it was just a year or two ago, even though the Fed's saying CPI is only up 2%. It's a tax on everybody. So I think Keynesian economic theory, it just doesn't make sense to me. Free market capitalism, supply and demand driving the outcome, that's all basic economic theory. Everybody should understand that. So the reason I'm a proponent for gold, and also the reason you see things like Bitcoin go from $0 to $1,300, I mean, this is a thing that doesn't even exist, is because it's limited in number. There's only 21 million of these that will be printed, right? And so
I think we should give Brandon a chance to
the
respond
demand,
here.
I'm done. I really am. The demand is driving the price up. Go ahead. I'm sorry. I didn't mean to take that long.
Well, I mean, you can recognize all that, but you're always left with the question, what do you do about it?
Yeah.
And like, if prices are going up, would you rather have cash or would you rather have assets?
Yeah,
so
and
that's always been Warren Buffett's
there's a
argument.
lot of ruin in a great nation, right? So you could be right, but you could be so early, it makes no difference.
You're right.
Right? So another thing is, as a microcap investor, I would just say that we all are attracted to like non-linear situations. That's partly why we like being a microcap investor. And I think there may be a tendency, I'm not saying for you, but for people to project non-linear situations occurring on the macro level, right? We see nonlinear situations everywhere. And that's not necessarily true. It's very different for the individual company and a system-wide occurrence. So, and basically even like you take the US dollar, I mean, it basically bottomed out, in 2011 or so? So it
hasn't bottomed out yet.
Okay.
The strongest currency in the world, baby. Be the best of the worst.
It's only
has
the
its
strongest.
advantages.
I made a mistake with that last comment, by the way.
It's only the strongest in the world because we have a global confidence game going right now where everybody in the world has agreed that it's the strongest currency in the world. Just like everybody in this room has agreed when they take a $20 bill out of their pocket, that sheet of paper is worth something. It's really not. You can't go get something finite from that. It's backed by the faith of the United States government. So if everybody buys in, that's where there's some value. That's what he's saying. It's the strongest currency in the world. It's the most reliable. But, I would argue that a lot of great empires have fallen due to the currency falling apart. I don't think it's going to happen tomorrow. I don't think it's going to happen the next day. I have a buy and hold portfolio that I have a 10, 20, 30-year time span on, so I don't completely disagree. I just think it's worth being mindful of a different ideology and a different outlook on things other than Janet Yellen is always going to save us, or Ben Bernanke is always going to save us. And by the way, Alan Greenspan is out over the last 4, 5, 6 weeks saying almost exactly what I'm saying. And 20, 30 years ago, he wasn't interested in this theory because he was the guy in charge. So if all hell broke loose, he was going to be the guy who was on the hook for it. But now that he's not on the hook for it, he's saying a lot of things that make a lot of sense that are starting to sound a little bit Austrian. So
his senility is getting to him. Alan Greenspan is also probably 90 years old right now. So here's what's interesting.
That means he has a lot of experience.
It's true though. So let me tell you guys something very quickly. What's interesting is that to the average person, you would think that Raven and I would be on opposite ends of the spectrum. The reality is that we both categorically agree on a lot of these things in the macro picture. I was the perma bear on Fox News before Peter Schiff, and Peter Schiff now has basically become, how can I put this, the champion of the short trade. And I think that everything that Raven says is correct. I mean, the CPI is complete bullshit because it doesn't factor the two most important things, which are food and energy. But you cannot dispute the fact that if you went bearish a long time ago and you went bullish a long time ago, The bulls have destroyed the bears. You cannot dispute it. The thing that made Buffett the genius and the guy who gets all the reverence in the world is he was the only guy who would buy something and never sell it. That was his difference. But my overall take is that there is no way we can continue to close our eyes and put our fingers in our ears and not realize what we're doing. A lot of these problems that we have are massive. They are systemic. These are not things that can be fixed with policy or Trump saying we got to make America great again, or some guy coming out and easing Fed rates by a quarter. This shit has already happened. The analogy that I always use is remember the movie Titanic. Remember the architect of the boat. He takes out that blueprint and he says, look, if we could stop it in two columns, the ship would be fine, it wouldn't sink. Unfortunately, we're at 3 columns. So we know the inevitable is going to happen. The dilemma has been postponed for so long that they'll never let it truly reset. Look at Japan. What fascinates me about Japan is all the things that we're doing now or we have done in the last few years is what Japan did in the 80s. And Japan is a much larger economy than us. Okay, I think people would agree with that. And they had the best case scenario take place. They've had virtually zero growth for the last 30 years. That's a best case scenario. I don't think we're going to be as lucky.
Can I just say,
You can't disagree. I just agreed with you.
No. Seriously. What he's saying is we're not going to let it get out of control because we've come this far, right? So we're going to continue, government stimulus will continue. But at some point, we may not have a choice, and that's the point I'm trying to make. And just 2 really other quick things. Peter Schiff isn't really the champion of the short trade. He's the champion of Austrian economics, okay? And essentially, if you went out and you went long gold in the 70s, when we took the dollar off the gold standard,
That was a bad idea.
you've made fantastic returns, right? You've made astronomical returns. You've probably outperformed the equity indices. And today, you have an asset that's physical, that you can touch, that's basically been a currency for 5,000, 6,000 years. Maj disagrees with me on all this stuff, by the way, too. So we have a lot of spirited discussions in the office. But the point is, you have something tangible, right? You're not holding a Federal Reserve note that can just be printed tomorrow. You're holding something that has, until the asteroid hits at least, a relatively limited demand of. And the very last thing is, Donald Trump ran on a platform that we were in a bubble, okay? Donald Trump campaigned, and he got a lot of votes, because during his campaign, he said, we're in the middle of a big fat bubble, and he even joked about getting Yellen out of there, because he said, these companies are loading themselves up with debt. I mean, you look at companies like Sun Edison, you look at companies like Valiant, it's companies that had access to capital and became so irresponsible with it that they've gone under. So he ran on this whole thing of, we're in a bubble. And now all of a sudden that he's in office, and he got a lot of votes like that too. People I know voted for him based on that, thinking, wow, maybe he has a little tinge of an Austrian economic policy. But now it's, the Dow's at 21,000. Thanks, Donald. We think this is an accurate representation of how the economy is doing. It's like if you don't understand that the economy and equity markets are 2 completely different things, you're not going to get it.
Donald Trump will say anything to anybody.
All right, so now, real quick, and this will be my last question before we get to audience questions. And just to follow up on what's been said in this last back and forth, just to bring it all back to the fact that we're here, we're at a MicroCap conference. There's a lot of MicroCap investors here, right? And what should they do with this type of information? With some of this theory that you guys are putting out there. How would you advise, or what would be your I guess advice for some of these investors here?
Don't listen to anything that we have said in the last 35 minutes.
Buy Amazon.
Buying great companies with earnings and revenue.
The guy that was up here,
share.
the guy that was up here at 4:00, that's running a newsletter that's looking at MicroCap, metal, essentially mining companies. You don't have to go 100% of your portfolio in mining, but this gentleman is running a newsletter pointing out microcaps that are in the mining space. So why wouldn't you have a little bit of exposure in it?
Jason?
I would just say that, tomorrow I'll be meeting with, a company that makes karaoke machines. And I really don't give a rat's ass what the price of gold is going to do 2 years from now and how it's going to affect the karaoke market. But I do care about, what's the adaptation of karaoke machines along the border where there's a high Hispanic population and they seem to be attracted to that, or them expanding to the toy market, and what's the opportunity there? I mean, that's really the questions that matter. So I think the thing to do is if you want to put some part of your portfolio in gold or some other, just for optionality's sake or to protection, go ahead. But basically, you got to get down to the nitty gritty, and that's how you made a lot of money in the past, and that's how you're going to make a lot of money in the future.
Brandon?
Yeah, I was joking, but I was also pretty serious at the same time. I think that the more that you can, tune out the media, tune out the news, trust no one, and stay laser focused, and you have to truly believe that somewhere there is an entrepreneur at a company that's turning around and they have a new product and a new idea, and the revenues are there and the cash flows are there, and you only need a couple of those to really make life-changing returns. I've seen it in a lot of other people's portfolios the last 5 years, my own portfolio, and really bought into this idea that if you can stay 100% focused on the micro, then the macro will take care of itself. And yes, sometimes it's harder, sometimes it's easier, but the more you stay focused on something that you can tangibly understand and look at, and a management team that you can call, and financials that you can review, and in Canada, at least in microcaps, there's simple financials. You can get the picture. Like as Paul said earlier, 90% of what you need to know is in the financials, and the more time you spend looking at the news, the less time you're going to spend thinking about the financials. So,
For sure.
turn off, throw away your TV,
I think all of this is great advice.
read LD Micro.
No, I think all of this is great advice, but my take is whatever you feel comfortable in, just buy half. Okay? The way that I look at it is my wife is an auditor. So I try to do something where if I lose everything, it's still a small enough amount that she won't get pissed off. So that's kind of the strategy. It's like, what was that in Patriot? Aim little, miss little. I try to take that with microcaps because you don't know. You don't know with, we're just basically, in the scheme of things in the financial world, just think about it. The 1,000 companies that make the index, the LD Micro Index, are 38% of the size of Amazon. Mm-hmm. That's pretty insignificant on a bigger scale. So the take is they may get impacted pretty quickly. So we've always had the mantra where we'll never have positions bigger than 5 or 6%, because I've seen the worst thing that can happen is someone gets absolutely obsessed with a company, and it happened with me, and I lost a lot of money. It was Premier Exhibitions, PRXI. It was just one of those things where we wrote it from 1 to 15, felt great. It got cracked at 13. We bought a bunch of 13, and we sold it at $1. So we paid all the taxes on the upside, and we made no money on the downside. We lost everything on the downside. So the consensus is you should never be, your investment should never take, a second life, if you will. Where if you lose the money, it's fine. But to Brandon's credit, you can also really focus on, there's an entire contingency of people that say, look, I'm going to focus on 3 or 4 names because if they are successful, I don't have to look anywhere else, which is perfectly valid. Just make sure you're not wrong.
Mm-hmm. So, sorry, one last question before we get to audience questions. We have some time. And because, we're at an investor conference. Sorry. Yeah, no, it's okay. Where everyone here will be going to presentations and taking one-on-ones, So how do each of you, and let's keep it at like a minute 30 each, max. Just saying, I'm not talking directly to you, Chris, I swear. But how do each of you approach assessing a potential investment at events like this? In other words, what are some of the qualitative measures that you do look for? And Chris, we'll start with you.
So I'll make it really quick. Qualitatively, obviously, he summed it up perfectly, right? You want a simple business that hopefully is cash generative and has a good balance sheet, can withstand a little bit of volatility. They've got a moat around their business. They're doing something that they have some room for growth. They have a runway to growth, and not quantitatively, qualitatively. You can back things up a little bit further in company history and look for those inflection points that we were talking about. Read a little bit, talk to management, go beyond the numbers a little bit, because it's not always completely about the numbers.
Mm-hmm. Jason?
What I'll add is that a lot of microcaps, the reason why they exist is because they promise to have a better product or a better service. And that may be a good reason why they exist today, but if they're going to exist in the future, it's because they can actually sell. And I think sometimes we don't talk enough about the sales cycle and how good they are in terms of just being salesmen. not in terms of selling their own stock, but in terms of just actually selling the product or service they're making. And so what I like to do is ask a lot of questions about, what kind of sales organization they have, who's heading it, what kind of importance it has. You just got to get a sense of whether they're as good at sales as they are in terms of developing this new product or service. Because that's really probably going to be the crucial element on whether they make money or lose money, and why they're around or they're not around in a few years.
That's interesting in light of recent news. Brandon.
Yeah, so one of the things that I've employed over the years that I really try and do is when you're at these conferences, you're going to hear a lot of stories, and being able to research the company in advance and looking at the filings and kind of forming your own opinion helps to put you in a good state of mind when you start talking to companies. When I first went to LD Micro, Chris put 35 companies on my schedule that I had not selected nor ever heard of in my life. So
All deep values, baby.
all revenue
I didn't know until
lists
today that
and-
all you buy is Canadian. I mean, that is like the most sacrilegious thing I've heard in years. I only buy Canadian stocks, and I'm based out of Los Angeles. The Canadian mafia is going to beat me up after this.
And so I was talking to a lot of companies that were really just stories, and everything sounded great, and I just wanted to get on my phone and buy, thousands of shares right off the bat, and woke up the next morning like, oh my God, what was I thinking? Like, you look up some of these things, and it's important to have going into the story so that you're prepared. You know the story, you're talking to management. And if you come prepared with questions, you're going to have a lot more value versus, show me the presentation, I've never heard of this before. Management's given that story 1,000 times already that day, and to have a full question set helps guide the conversation. You're going to get a lot more actionable insights coming out of that.
Chris?
Look, the reality is that most of the microcap companies today will probably not make people any amount of money. That is the harshest reality of all. With that being said, everyone is looking for those one or two ideas, like the Hanson's Naturals, like the tasers, that have something distinctive. But you guys know better than anybody else, this is a tried and tested room. The smaller a company is, the more important management becomes. You go to conferences to meet with management. You want to ask tough questions. You want to see how much skin they have in the game. You want to see how many raises they've done and how many times they put their own money within the raise. So there are obviously a lot of variables that can extract the story that they're telling and the story that is ultimately reflected. Mm-hmm. So no one comes into this saying that I'm going to buy 50 companies and 40 of them are going to go up and 10 of them are going to go down. That ratio is way worse than you think. But it's just like poker. When you know something, you bet big. And I've seen it happen before. Even in our own history of trading for 15 years, I can only count with one hand the times that we've made over 10 to 15x our money. But those are the investments that allow us to be speculative. Those are the investments that allow us to make investments in a lot of other companies. And then what you do is you peel the onion. You keep peeling it, you keep peeling it, and then you see what is left in the end. At this conference, there's going to be one or two big winners. The question is, are you going to be at the right place at the right time?
Amen to that. And I think with that, let's open it up to questions. With that,
Mic drop.
Chris Lahiji, not Chris the Raven.
Oh, Chris, real quick, let me just repeat the question. And I know you love this question.
Oh, I do.
Yes. So,
Like an easy 20-foot shave.
so Chris, the question was, is that, why do you think a lot of these companies are going to private equity? Not enough new names are going public.
My man, this is the question for the next 10 to 15 years. I think the reason why no one's really going public anymore is because there's a lot of cost affiliated to it. There's a lot of regulatory risk. There's a lot of fine details that you have to go through. And now, for the first time in history, you can be a private company and never have to go public. Look at Uber as an example. They have raised almost $15 billion with a very small set group of investors. So my take is now Reg A, and there's a lot of things that are taking place that are making it easier for companies to come public. But my consensus is if the federal government, if they showcase more leniency, okay, and you can still be hard. You can still have those laws. So if someone breaks them, you ultimately get punished. But my take is the easier and cheaper it is to go public, the better everyone in this room is going to be. And let me tell you, slowly but surely, over the last 10 years, the number of equities in North America has been going down like this. It's been going down on a consistent basis. Companies going private, companies getting bought, companies going bankrupt, companies merging. And this is a pretty systemic thing. So my consensus is we're moving in the right direction, but we're not moving fast enough. And I don't think the government is on a very high basis is doing a lot to make this easier. Can you imagine what would happen if the Trump administration basically said any company with 500 million in sales or less, if they go public, doesn't pay taxes on the income for the next 3 years? Can you imagine how many companies would go public? So that's my take. I mean, 2005, 2006, you'd have 10 companies going public every week. You have 10 companies, if you're lucky, every 3 months. So this is a big problem. I see it getting a little bit better. I see it getting a little easier, but it's still on a down curve.
If I could add just to that, this is a shameless plug for Canadian investing, is that those...
Paul, what have you done to Brandon, dude? What have you done to him?
A lot of the dynamics that exist in the U.S. and as Chris mentioned, the VC market being so strong, you don't quite have those dynamics in Canada, or a lot of those options. And also adding to that, the cost to go public in Canada, and especially with the CSE introducing these lower cost models and options, have somewhat lessened the effect of the decline in Canada. And so we've actually participated in a few companies that have gone private to public and at very small revenue base, things that likely would never happen in the US. And so if you are looking for a continuous pool of microcap investments, I think that Canada will have an edge over the US.
And this is the only nice thing I'll say about Canada today. Canada is doing it right. They have the right mindset. And now what they need to do is the same thing that has to happen in this country. We need something that is popular and well-known to go from $2 to 100. The way that you get interest in a space is that everyone in the totem pole makes money, not just the guys at the top. And let me tell you, a lot of the big winners that we've had over the last 2-3 years have been Canadian companies. So there is something that we can do, we can replicate to kind of hope we can get some of that as well.
Anybody else had anything to add to that? Nope.
I just add one thing, and it's that I'm not an investor in marijuana stocks, but I think the wonderful thing about microcaps is that you take a company like, which we mentioned before, like Bioscience, which went from like insecticide to like expensive pills for like pregnant ladies in like Saskatchewan, and 5 years from now, there's going to be some marijuana company that like moves to machine tools, and it's going to make someone a lot of money, just because the management is good, even though whatever their original plan was wrong. And that's the wonderful thing about microcaps and why you do have to go through all those different filings. And because, you start off with marijuana today, you could be machine tools tomorrow, and someone's going to make $1 million off of it. So just something to think about.
Chris?
And I'll make my required token, the world is ending comment here. So prepare yourselves. No, mostly I agree with everything these guys just said. What I'll just say is, if you think the venture capital market is in a boom right now, right? And I would argue it's in a boom because money is cheap right now. Look at some of the financials of some private companies that have recently gone public, and also some companies like Uber, where hedge fund managers that I know are trying to get shop shares at 15%, 20% discounts to the company's current valuation. The company lost $2.4 billion or something like that this year. So I agree with him wholeheartedly, by the way, that deregulating will help spur an influx into the equity markets. But what I tell you is there's a big difference between having a venture capital boom and a company like Snapchat or a company like Uber that, Uber may never be profitable. Like it's a reasonable thing to say that if Uber doesn't IPO, I mean, it could just go under because they have extremely intensive capital needs. And so you have to ask, why are VCs investing in it with the current state of its financials?
Any other questions? Kevin?
Okay, we've all been talking
Absolutely.
The best thing in Canada or whatnot. Why I'm looking at a stock in Australia right now. Okay?
Here-
Looks reasonable, okay? But you know, of course, Ian has introduced results in India. Why am I chasing around? What's going on in the global scheme of things in micro?
So here, let me just repeat it real quick. So that question was from Kevin Shea, by the way, also a guest on the Planet MicroCap podcast. And his question was, why aren't we looking at global microcaps? You know, why aren't we seeing what's going on in Australia, for instance, or India? You know, Chris?
Kevin, it's an excellent point. I think obviously it's a cultural barrier, a language barrier, the ability to access information, the ability to trade. What we did is we hired a PhD from Caltech a few years ago to basically analyze all our trades over a 10-year period. And we found something very interesting. The closer a company was to us, the more likely it is that we were going to make money. So we were trying to figure out why this was the case. Was this just an anomaly? Was this something that, you know, could you extract it and see if that ultimately made sense for anybody else? We thought that it was because the closer you are to someone, the less likely it is that they'll be dishonest with you. So that's what we ultimately came with. I mean, the best companies in microcap on a valuation basis have to be global names because value is directly correlated to how many people are seeing it. Why do you think there's never going to be another Buffett or a Munger or any of these guys? Because when they were looking for discarded assets, there was really nowhere to go for information. I mean, there was a directory that would come out once a year and you would look through it. Today, because of technology and because of, you know, fast internet connections and stuff, you know, it's amazing how quickly news gets out. So you want to go to the places where there's less news. So Barron's wrote an article a few years ago, which was fantastic, by the way, called Africa, the Last Frontier. And there was a lot of big, very profitable companies in African countries that were trading at ridiculous multiples. You know, even one guy, the guy from the international fund at T. Rowe Price, was buying one of South Korea's one of the largest electricity companies for 2 times earnings. So yes, the reason why we don't do it is because we don't have the necessary resources and we don't have anyone on the ground to actually go there and check things out.
Yeah, I can say that my first couple successful years in this, that's what I was doing. I was looking internationally, and there was a time where I owned Canada, Australia, Sweden, and maybe 1 or 2 U.S. stocks. And the quick story I always tell is there's this Swedish brewing company called Kopparbergs. I don't own it currently, but I did at one point. And it traded on the Nordic Growth Market, which is a collection of 30 Scandinavian, almost all biotech and mining companies. And here was this one brewing company that had this pear cider that was taking off. Is a little bit different than apple cider, and it was trading at 4 times cash flow, growing, you know, earnings or revenue 30%, earnings 50%, and invested in it. And even to invest in it, I couldn't buy it through Fidelity on their online platform. I had to call somebody there. They had to call in and basically like write it down on a piece of paper and take it down to the floor, and they let me know 3 days later that I had gotten the shares. And so like, if you're willing to put in that effort, I think there's tremendous value, and that stock went on to go up over 10x. But I think the issue is if meeting with management is a core part of your strategy, and there's always a debate of whether should that be part of your strategy or not, then I think it's difficult. And what I found in Canada is it was far away from the US, where you had kind of the same dynamics where people weren't looking at it like they look in the US, but you had the same accessibility. You know, I could fly to Calgary faster than I could fly to Atlanta and be sitting there with management and getting those insights that are a core part of my strategy. But if that's not part of what you do, then there's, in my mind, no reason why international isn't a good play.
All right. So we have time for one more question. Fawad, I saw your hand up. So you have the last question. And please, we only have like a couple minutes left. So let's keep answers to like a 30 to 45 seconds. So Fawad?
So you guys all have somewhat different strategies, somewhat. But I was wondering if you pay any attention to the sectors where the company is, and if so, what is your most interesting sector and what's your worst?
So the most interesting sector to you as of right now?
Go ahead, Ray.
Yeah, real quick. So Maj has a specialty of basically trying to find, so I discussed at Geo, a lot of what we do is we try to find companies that are in inflection points. And one of the inflection points that Maj has been able to identify over the last couple of years, like really prominently and prolifically, are companies that have traditional business models but are moving to software as a service offerings, or are going from, we just looked at a spinoff from Donnelly, R.R. Donnelly, which is a company that does capital market stuff, and they still do everything by paper, right? And so they're getting ready to move the business to digital. And so we see a wide variety of companies that are either going from paper to digital, or they offered services previously that were manual services that are now being offered as software services. And not only have we been prolific in identifying these, but I think that's probably the one area that I would look at, because if you have a company that's doing business traditionally and they have a traditional multiple, and you can put your finger on when that inflection point is, and you know that the market can assign not even a full SaaS multiple or a full technology multiple, but half of a SaaS multiple or half of a technology multiple, there really stands to be some attractive upside. And so, yeah, I guess technology. Companies moving from traditional to digital, regardless of their sector, really.
Jason?
Yeah, I don't have a particular sector that I look at. I try and find companies that are going to be hopefully, good ROE in the long term. I mean, in some ways, I just invert it. I just stay away from certain sectors, stay away from certain areas, and basically, I think you just got to be. I get into trouble when I drift away. I mean, and the same thing. I understand people want to go abroad to different countries, but every time personally, when it's just if I'm tempted to go to Australia or New Zealand or Singapore, it just means I'm really not doing what I can do well. So that's what I just found that it's just simple. If I can understand the business after looking at it a day or so, that's fine. If I don't understand the business, then someone else can make some money. I won't, and that's fine. I'm fine with that too. So there's no particular sector that I just do it. It's just and I don't care if someone else makes money. Some people are just jealous of other people making money, and then they're like, okay, that FOMO factor, right? The fear of fear of missing out. And so you just got to
Moving out too.
Moving out too. Yeah, that happens every later on. But
They don't want to sell.
you just don't want to fall to all those behavioral economics tricks. Anyway.
Yeah, I believe that the best sector is the one that you understand, and the worst sector is the one that you don't have any idea what you're doing in it. So it's kind of the classic Buffett methodology. For us, that tends to be consumer products, business services, software as a service. Those are ones that are simple, typically can have some of those moat qualities that Buffett talks about in the microcap space. And those are the ones that can grow and get bought out, at least from our experience. For us, we don't do any mining or resource. We would lose a lot of money, I think, very quickly if we tried to. And so we won't even look at a single name. And that's pretty different from what happens typically in Canada, but that's what works for us.
Chris, close this out.
Medical devices with razor blade business models. We've been focused on this segment for about 10 years now. We usually have one or two of our core holdings in this space. The reason, is that we have a deep value bent, but what we've learned is that if there is a company with a specific niche and they are cash flow break even or even profitable, someone will pay 8 to 10 times sales for it eventually.
All right, with that, I want to thank everybody for participating and being here, and thank you all my panelists for being here, guys. Really do appreciate it. I loved it.